Hi, good afternoon, everybody. I'm Debbie Faulkner, the owner of Berg Faulkner Law. Many of you already know me, and this is my good friend from high school, Brandon Shepler. And I have brought Brandon here today to do our second element of Panic to Pandemic, investing in a new paradigm after COVID-19. So Brandon and I are not business partners per se, we're friends, and Brandon is a principal of Shepler and Associates, a wealth management firm. But I brought him here as a guest because he's a chartered financial analyst. And what a CFA means is it is the highest level of international legal and regulatory recognition of finance-related qualifications. Yes, I got that off Wikipedia because I cannot memorize that myself. But basically, this is a designation that hedge fund managers and portfolio managers have. It's the highest designation you can have. So Brandon had to take an exam over the course of 3 different years and pass each part before he was eligible to take the next part. And there are very few CFAs around the world that are in private practice like Brandon. So he has really a deep view of how markets work, and he analyzes different things from in a way that most advisors are just not able to do. So I welcome all of you to our seminar today, and we're just going to have a question and answer session. You guys viewing us at home, feel free to type your questions. We are here live, so we can answer them in real time. If we're able to do that, we will. So I invite you to both subscribe to our channel so you get updates for future seminars, and also to type out your questions and we will answer them in real time. So how are you today, Brandon?
Doing pretty well. Been stuck at home.
Stuck at home, yeah, that's most of us.
Yeah.
That's most of us. So, all right. So the markets have recently recovered off of their all-time lows that we've seen in this cycle. So do you think that the worst is behind us, or do you expect that the markets will go down another time?
To say that the worst is behind us is hard to really pinpoint, considering we still really don't know how bad this pandemic will be, and also how the response will continue to evolve. We recently had an extension of social distancing by another 30 days, and I do think that obviously that was unexpected. But to say that the worst is behind us, I think the unknown is behind us. We know that at least we're dealing with a real global issue here, and it won't be short-lived. So I think retesting the prior lows, which were about 34%, is highly likely. Relief rallies, as they're called, are not uncommon. So in 2008, you had a very similar path where there was a relief rally, as they called it, after the initial sell-off. And then the market continues down from there, retests those lows, usually breaks them. And then once you kind of find a true bottom, which again, no one knows when that true bottom is, the rally actually will recover and take off. So I'd say, down 37 to 40 still from like the all-time highs is realistic. We're down about 23 from that right now. So call it 15% from here back down is likely. But again, this is highly different than prior recessions. It's not, there is arguably a silver bullet out there. And that's the other unique fact here is obviously a vaccine is a silver bullet, or flattening the curve faster than expected is a silver bullet. There's things that could recover faster. They're just not predictable. If that makes sense.
So unlike other recessions where there was more than one cause, you're saying this recession is caused by one thing. So if we get a vaccine, for example, that might kind of patch up the market in a way that's faster than other patches for previous recessions. Is that what you mean?
Yeah, correct. So like most recessions historically actually were caused by oil markets. 8 out of the last 10 bear markets were at least some factor involved oil. Oddly enough, it usually was an oil spike in prices. This recession is obviously very different in the sense that it's caused by a pandemic, so a virus. And oil markets are actually a secondary issue, but it's not a spike in prices per se. It's actually a decrease in prices that's actually causing further disruption there. So there's arguably 2 shocks to the system, but one is definitely pushing on the other.
Okay.
So, oil supply is high, oil demand is low, prices are low. So what you're seeing is a lot of companies in the oil space are not profitable. They're filing for bankruptcy. You already did your first bankruptcy 3 days ago.
And which company was that?
It was a small, what we call midstream company out of Texas, West Texas. And that's kind of the canary in the coal mine. So obviously there's more than one factor at play here, but the primary cause to sell off is definitely the virus and the pandemic and the fact that we're reacting to it the way that we are.
Okay, so you had mentioned that you said there was a relief rally. So what that means, just so that I can understand, is that the market was at its high in February or so,
Yep.
and then it went down. And then there was the relief rally is when it temporarily kind of goes back up, but it's expected to go back down.
Not just expected to go back down, it's just markets are typically, they price in the worst first and ask questions later. So typically you see the market sell off and it happens very fast. This was historically fast, but usually it's worst case scenario first, then information digested, people look for optimism, and once optimism is kind of validated, the market usually recovers a little bit. But like anything, emotions usually are very polarizing. So you have very negative emotions first, i.e. a big sell-off. Then you have over positive emotions, like as in the stimulus package will work better than it will, so market recovers. And then that negative reality kind of takes over again, usually drives markets back down. So it's more of just I'd say the overdone panic and then the overdone euphoria, or exuberance, as we would call it, are different words that lead to overselling and overbuying in the short term. And it takes some shaking out to, I would say, normalize returns.
Okay, so there might be a spike and then it kind of goes down and then it normalizes in somewhere in the middle.
That's the behavioral side of it, I guess we would call it. So obviously markets are based on fundamentals and theory, but behavior drives markets.
I understand.
So
in the case of the coronavirus situation, if we don't have it under control by the end of the summer, do you expect the market to adapt to the current circumstances?
So this is definitely like the big unknown here. Under control is very hard to articulate. So under control domestically, if we can get the flattening the curve, as we're calling it, to happen by the end of, let's say, April, infections can continue into the summer, but the rate of infections is what matters. So what you're seeing right now is hospitals are having a hard time with capacity. So it's not that the infections are an issue, it's that how quickly they're happening, because we can't actually deal with the problem. So you can have the same amount of infections you have right now, but if it was spread out, uniform across the whole country, and it was happening at a predictable rate, we could handle it. But it's happening in these what we call hotspots. So like New York, for instance, being flooded with patients that they can't take. You're seeing the same effect right now in Michigan. Michigan has a very high infection rate now compared to, on a per capita basis, compared to other parts of the country. So it's the flare-ups, as you would kind of call it, that are leading to, I'd say, like larger death rates, larger disruption in those areas. And until that's managed, I'd say that's a cause for the markets, because you're also going to see a lot of, I'd say like travel restrictions to New York, more shutdowns in those areas, more disruption. So until we can kind of like normalize the situation, markets, I would say, react and don't adapt. Now, with that said, other countries are further along this and they're showing promise. So China, obviously, they dealt with this in January. It was a China-only problem. They, to say that they're forthcoming with data, probably not. But that doesn't really matter. It's perception that matters. So the perception right now is that China has this under control. And as a result, manufacturing came in better than expected last week. China's markets are actually holding up and recovering faster than ours are. And the same is true in South Korea, who handled this very differently than we did, and handled it, I would say, much better. So there's definitely hope, right? So if we can correct at least some of the issues before summer, I do think there's at least chance that this is not a long-lived recession. Now, for it to be like a V-shaped recession, some people are calling it, where like we come out of this thing right away, highly unlikely. But a U-shaped, probable, as we would call it. There's also called hockey stick shaped. So you're a hockey fan. So those are the recessions that kind of just take forever to get back to normal. We don't think that's the case yet. We would argue, and I think this is where this is up to debate, but U is the more proper path, where we probably have a pretty prolonged recession at the bottom, but a fairly quick recovery. Not right up though, as you would kind of call it.
I understand. So another question that came in was, how does the government actions to contain the virus impact the market?
Well, obviously this blanket approach of just shut everything down and panic and shut everything down more, and panic is not ideal for markets.
You don't say.
Yeah, so if you look at South Korea as an example, they were better equipped to test rapidly than we were. And obviously that was one shortcoming in America. We did not have tests ready and the ability to test rapidly on the onset. So in South Korea, what they were capable of doing is when infections were found in an area, they were able to respond by rapidly testing in that zone and then quarantining and shutting down certain parts in a faster effect. The United States has not been able to do that. We've been kind of, seeing what we call hotspots, and then we're just having to like immediately react to what's already an outbreak. And additionally, too, like Korea did not have to shut down every aspect of the economy as a result of this, so their economy did not have the same whiplash that we've seen. So yeah, policy is obviously an issue, and that's undoubtable. There's 10 million unemployment. There are new unemployment cases between end of March 21st and March 28th. Those 2 weeks was 10 million total.
Wow.
So yeah, I would say the reaction is probably a little overblown. It's just hard to really,
It's hard to temper that reaction when there's such high unemployment rate. And if I can ask the people that are watching, please subscribe to our channel so that you can get updates for our future webinars. And thank you for the new people who have just joined. So on to what you just said about the unemployment rate. What do you think is going to be the long-term impact on the market of this high unemployment? And secondly, do you think that unemployment, if people are, our businesses are back opened up and we get this under control, and our hospitality industry is back and things are back open, do you think that will cause an immediate effect on the market?
I think there's still going to be a giant shift in terms of how consumers behave after this. You've already seen it in the works for a decade. So malls were struggling to figure out how to get foot traffic back up for the last 10 years or so. This very well might be the death blow to a lot of mall operators. You're seeing legal battles now with like Cheesecake Factory and Taubman over rent being due for the month of April. That's probably not going to end there. So I do think that consumers are going to shift to maybe more small, again, experience-based kind of service industry, but even that's up for debate. There's going to be a huge scar left here for business owners. Business owners are not going to be as likely to expand or to put as much into their buildings anymore. So like a lot of your experienced restaurants dump millions of dollars into them to create like a unique experience, and at what cost now? So I think that there will be a definite change in how bars and restaurants will operate and work going forward. I'm not sure anybody can really answer that question in terms of like how they respond. And as far as the tourism industry goes, obviously that'll change as well. You're looking at cruise line companies that are taking out massive amounts of debt right now to try and sustain the next 12 months. Airline companies are consolidating flights, furloughing employees, and that's not going to stop bleeding either. So there's definitely be changes there. You might see airlines redo entire flight paths, entire routes over this to different cities. You might see cruise ships operate cruises differently, where they're shorter cruises, not longer, because it's more predictable revenue that way, and you can actually cancel cruises easier and adapt to like potential pandemics. So I think every aspect of this is up for debate. There's not going to be a quick answer to that. And as far as the jobless situation goes, if this carries out longer than expected, then there are permanent closures. Businesses don't come back from this, and in that case, then yeah, there's real job losses that are not temporary. So that's a big risk too, is how long does the economy stay closed? Because even with small business loans that you're seeing, even with the government stimulus package, businesses can't operate for 4 or 5 months without revenue, and that's just.
So based on that, which we know to be true, businesses can't operate indefinitely with no income. Do you think that first, is there a place in the stimulus, for hospitality industry and the tourism and travel industry? And second, if there isn't any provisions for those industries now, do you perceive that the government may in fact have another stimulus for travel and cruise lines and hotels and industries like that?
Yeah, I mean, there obviously are provisions in there. Airlines are capable of asking for support already. Cruise lines may or may not still get certain support. They're debating that right now. And additional stimulus is highly likely, but the problem with government is always the sledgehammer approach. So it's the fact that politics don't drive pinpoint precision. They drive sledgehammers, because that's how you get voters.
That's right.
You don't get voters by trying to solve problems precisely. And that's a huge concern here, is that even the current stimulus bill, it's affecting workers heavily right now. Business owners and employees are the ones that are affected the most in the situation. Retirees are not. Yet the IRS backed down last week and said that Social Security recipients don't even have to file taxes for last year. They'll get automatic checks as well. And not to make this again like a Social Security issue, but people that are on Social Security are not actually affected in the same way. Now, should they get some sort of help? Not saying they shouldn't, but is it commensurate with a mother of 3 right now who just lost her job? No. So that's that sledgehammer approach where everyone's treated equally and it's not impacting everyone equally. So I think until you can kind of resolve that or create, like you said, maybe programs that help different industries differently and with more articulate, answers as to how that's going to happen.
As opposed to just a blanket approach. That's kind of what we're seeing right now.
Yeah, and I think that's the issue too, is like the government likes to throw out big numbers like $2.2 trillion, but in terms of how that's distributed or how easily it's distributed is up for debate. And that's another thing for business owners too, is they need relief now, not 3 months down the road.
Right.
And that's the other concern, is a lot of business owners are not really sure how quickly this will happen. We still don't even know.
Right. They were supposed to have a program starting today, and it's just been a complete train wreck.
Yeah, Bank of America had applications coming in. Other portals are down. So that's an issue. And then now the direct deposit debate too for the $1,200 checks. If you do not have direct deposit on file, it might be 3 months before you get a check. So there's definitely some headwinds to this too that will make the recovery, or at least the attempt at recovery, not as seamless as it could be.
I understand. So how do you see this impacting long-term debt for the government and for corporations?
The long-term debt issue in the United States was already, alarming. This will be something that we've kicked the can down the road about as far as we can after this. I'm not really sure we can walk away from this and not acknowledge that we have a spending issue in this country. The deficit is going to balloon to a level that was supposed to happen 15 years on the road, arguably.
Wow.
And that's not something that should be taken lightly. Obviously, interest rates as low as they are, debt can be refinanced, on a government scale, but you can't refinance debt forever unless you fix the kind of like structure of how debt is paid. And, the current issue we're having is that if you look at like the population pyramids that I kind of talked about last time. So if you look at population pyramid in the United States, working years are 20 to call it 65, and 20 years old, 65.
Mm-hmm.
So if the majority of the population is below 20 and over 65, then you're putting the stress on the middle band there to basically uphold all debt in the United States at a rate that can't be sustained. So
you're upholding the debt by paying income tax?
Taxes in general. I mean, Social Security tax, Medicare tax, income taxes. More than half of all Americans don't pay income taxes, but they do pay FICA. And that's the giant drain here, is that, as medical costs have gone up, and this will obviously be a further drain on that with what we're seeing now to the healthcare system. Medical costs have always been the unknown element here, because medical, innovation has allowed us to keep people alive for far longer and to, improve life at a much higher rate. But, that's not free. So that's an ongoing concern, is the more medical breakthroughs we have, the more money that goes into spending on
Social Security, basically.
Social Security and Medicare and Medicaid. That's something that we need to continue to pay for. And obviously, as a business owner, yourself, myself, 15% is already allotted to self-employed individuals. You're paying 7.65 on both ends. You're paying yourself, FICA for yourself, and then as an employer again. So you're already paying the majority of the taxes that are paid by individuals, not going to the federal deficit, as we call it, is going to Social Security and Medicare as it is. That needs to be addressed, obviously.
So when the government has debt that it needs to refinance, I mean, how does that exactly work? I mean, can't the government just print more money and use more money? So
there's this is like a second conversation on this one, probably next week. But MMT, which is like a modern viewpoint that debt really doesn't matter because inflation doesn't matter, and essentially the gold standard hangover, as we would call it, has led to this idea that we don't have balanced budgets. So you do see a lot now in like debates, and again, I'd say this is like a larger conversation, but yeah, the government technically can continue to print money or continue to issue new debt as long as they're capable of essentially refinancing it and making payments, never defaulting. But this is a structural issue globally. You're seeing global debt at levels that people would have thought impossible 20, 30 years ago. So there definitely needs to be a shift in terms of how countries do issue debt, pay debt, and I think we need to really have a more open debate on how economies handle that. But it's something that this will impact dramatically, and I'm not sure anyone has a real answer either in terms of how it's handled.
So in the news right now, there's a lot of talk about a death cross. What is a death cross related to the market, and what does that mean?
So the death cross is a technical indicator. It's when the 200-day moving average is the most typical.
The what?
It's called the 200-day moving or simple moving average.
200-day simple moving average?
Correct. So it's essentially a longer term indicator in terms of market movement. So it takes the average movement of the S&P over 200 trading days. And then there's a shorter term indicator called the 50-day simple moving average.
Okay.
So when the short-term trend line and long-term trend line cross, as you would call it, it's a negative sign, and that's the death cross. So it's essentially...
Why is it a bad sign?
Because momentum is all of a sudden to the downside. You're basically saying that short-term trading is now suggesting further decreases in prices. So it's a chart. It's really easy to visualize, see visually. If anyone wants to Google, just type in 500 or 200-day, 50-day moving average death cross, and it's pretty easy to see it. We actually saw the death cross in 2018 when the market sold off almost 20% in the fourth quarter. So typically what happens is you have the cross, as you call it, so that's death cross, downside accelerates, then the recovery is confirmed when they cross back over. So it's called the golden cross.
I see. So you take one indicator and another indicator, and if they're intersecting at a certain point, then the markets are likely to keep going down. Correct. If they intersect a different way at a different point, then they're likely to go back up.
Yep. And there's two problems here, though. So the death cross properly predicted or predicated the several market crashes. So that's why people like to use it. So 1929, 1938, 1974, and I'm missing two. But it's been pretty reliable as an indicator for downside. The issue is we already had a bear market prior to this cross because of how quickly it occurred. So obviously it didn't call the bear market. And you've also seen some divergence there where the NASDAQ, so the QQQ, and the Chinese index, so if you look at indexes as representative of the fund, they haven't seen the death cross yet. So that also kind of insinuates is that the S&P 500 has a lot of what I would argue to be overvalued companies. So that's where I still think this is another debate too, but the idea that technology and the growth value kind of argument here, I would say that companies have been unfairly rewarded by being in indexes. And as a result, right now you're seeing that unfair, reward kind of fall apart, and that's where the S&P is.
Oh, okay, so you're saying that some companies have been sort of overvalued by virtue of being a part of this Standard & Poor's or part of being a specific index.
Yes.
And that is, their overvaluation previously is coming to head now.
That's another reason why the market sell-off probably happened as quickly as it did is 80%, give or take, of all trading is now done in index funds. When it comes to S&P.
Does that mean
large block trades and large drivers are simply occurring in the indexes themselves? It's not necessarily individual stocks being traded by mom and pops anymore. It is a big push towards indexing that has really led out argue to rapid price decreases when people panic because you're seeing the same items you sold in uniform.
I see. So basically there's a lot more people invested in funds as opposed to individual stocks. So if the funds as a whole sell off,
the same funds as you call it.
The same funds are
crowded
they
trades.
have very good. For those of you who are just joining us, please subscribe to our channel so you can get updates for our future webinars. And thank you for joining us. Feel free to ask your questions. We are here live with Brandon Shepler, who's answering various questions about the marketplace. So Brandon, based on what you just said, there are some stocks that you say have been sort of receiving a little bit of a bump for being on certain indexes. Do you think there are certain industries that were perhaps seeing too much of a fall in this last sell-off? Like maybe they really shouldn't have been sold off at the rate that they were over the past month.
Obviously there's opportunities in every market environment, I would argue. Right now,
opportunities meaning opportunity to make money?
Yeah, again, this is always a debate over time horizon. It's not going to make money when viewed in a proper time horizon. But what I would suggest is, again, this is a pretty logical argument. If individuals are forced to be home, they're going to spend more time online. You're already seeing that with the workplace. So digital workplaces are now, seeing massive user adoption. Microsoft announced that their Teams platform, I think, saw 200 million new uses, not necessarily new users.
Wow. That's pretty extensive.
Yeah, Slack is another company, Zoom Video. So again, these are all coming to operate in that space, and not saying anyone's better than the other. It's just that's an area that you're going to see. I would say
like a little,
at least in the short term, because there's what else do you do if you're a business owner trying to work remotely? You have to use these programs, and there's only so many options as there is.
Right, that makes sense.
And then from there it's trickle down. So you have the need for increased cybersecurity. The WHO website has been hacked multiple times in the last few months, or at least attempts have been made on it.
That's pretty crazy.
Consumers are being hacked more routinely right now because they're online more often. So more online time means more potential hacks. So cybersecurity is another area that would see increased revenue, at least long-term over this, because there's going to be increased cybersecurity issues. Data storage. So obviously more we use computers and the more you use your cell phones, more data. So data storage centers, data storage providers.
So do you think those are companies, data storage companies and internet security companies that will see a long-term growth pattern, or is it sort of a short-term bump, do you think, and then it will sort of trickle down and normalize?
So that goes back to the initial kind of discussion on how does this impact the job market and consumer behavior long-term. And I would say that there's always going to be permanent effects, maybe not across the board. But if companies see remote work as effective, there's a chance that maybe they don't require as many, in-office hours. They might allow more remote work permanently.
Yeah, and I know that's not necessarily predictable per se,
no, but
it's possible.
I'd say it's highly likely, and even consumer, mentality of shopping online. Online grocery shopping has increased 100% in the last 2 months.
Wow.
So do you go back to the grocery stores? If you get used to this and it's easy and it's no more costly to you, and the orders are on auto and they deliver to your door.
Right.
Maybe you don't turn it off when this all ends.
So those would be online grocery delivery companies or places like Shipt and things like that are have seen an uptick in business.
They have. And then the other, unique part here too is obviously Amazon, Walmart, the big players are big benefactors here from online shopping. But uniquely, a lot of things have been sold, are essentially sold out. So Amazon has seen a lot of, backlog in terms of order
that
inventory.
makes sense.
So some of your key or niche players have actually seen an uptick as well in revenue. So it's kind of a spillover across the board where some companies are benefiting because they essentially were lesser known players that now have inventory that other people don't have.
Right.
So I think across the board, there's definitely some opportunity there, some short-lived, some long-term. But that's where there's definitely divergence. You're seeing, I'd say, some unique opportunities, but I wouldn't all of a sudden start throwing every dollar you have into a fad trade, as we would call it. Assuming that this is a forever change. I think it would take, again, a more diversified approach to this and look at companies across the spectrum to make sure that you're understanding essentially what risks are out there for each company or each sector, because again, no one is immune to this.
So what do you think about the travel industry in general? I mean, do you think it's likely that the federal government in the United States is going to allow huge hotel chains to fail or, cruise industry to fail as an industry?
So hotel chains, maybe. They don't really have the same argument that airlines and cruise ships can make in terms of necessity towards infrastructure and military application, et cetera. So there's certain things that I would say differentiate those kind of industries. But across the board, no, I don't see anyone really letting them go at a $0 value. Because again, like every company has what we call intrinsic value. They have a price that they should be worth just based on selling everything they own. Their brand name.
Right, they're real assets or something. So
a lot of times, if you look at the last recession, there were companies that were trading below intrinsic value, as you would call it, which implied that either A, they were going out of business and everything was worth less than it said on paper, or B, the company was going to survive and they should be worth more than they were trading at. So that's where Warren Buffett always made that argument that, you can look for value in oversold markets. And I think Glenn is another advisor I work with as part of our team. He always quotes the Warren Buffett quote of, what is it?
Stocks return.
Yes,
markets like
the recession.
Stocks.
Yeah, stocks return to rightful owners in the sense that people that buy stocks in this time frame understand the risk they're taking, because this is when it's actually smart to maybe get into equities. People that shouldn't have been in the equity markets panic and leave. So that's essentially what you're seeing right now. I think in the travel industry, there's definitely going to be some losers. Some companies might not come out of this, but I would argue that a handful do, and they're probably trading at a multiple that suggests oversold.
So what that means in terms I can understand is basically some of the stocks in the travel industry are probably way undervalued based on their hard assets and the things that the companies have that, if they sold off, their buildings or their machinery or whatever they do own, they would be worth X, and maybe they're trading close to X. Is that what that means?
I'd say so. I mean, again, this is still, I'd tread lightly and I would enter slowly in anything you do right now, because there is a lot of unknowns still in terms of how long this lasts. But yeah, I would still argue that several companies at current levels, or at least look attractive. because yes, companies will survive this. This is not the end all be all for every travel industry or every single travel company. So I would suggest at least exploring that for investors down the road, or at least some people may look into that if they have the appetite for risk.
Excellent. So what do you think of the international markets? Do you think there are any opportunities overseas investing right now?
Yes, I would say, Europe is an area that hasn't had a lot of structural issues after this. European countries face demographic issues that have already been unfavorable from a growth standpoint prior to this outbreak.
What does that exactly mean?
So Europe has always had a growth issue, at least in the last decade. They're not growing. Like GDP growth in Europe is stagnant. It's very slow. Populations there are older than the United States across the board. Italy is the second oldest nation, depending on how you age, in the world outside of Japan. Germany is number 3. Spain is not far behind. So you see a lot of, I'd say, issues in terms of how this, virus or this, pandemic affects Europe in general. Death rates will be higher because of age alone. Debt might need to be higher too because to stimulate the economy might take more money. So Europe is going to have a very fragmented, I'd say, investment, kind of recovery. You might have some countries like Germany whose death rates are low recover quicker. Italy might recover over the next 10 years or never. But so to try and pick Europe as like a place to invest is difficult, I would argue. Whereas China, again, to trust the data or not is up for debate.
Right.
But their recovery has been, slightly ahead of ours because they dealt with this first. Their markets are actually holding up better than ours are at the current moment. So I'd say looking overseas for the discerning investor, there are opportunities. China probably has a few companies that I would say are relatively attractive or very attractive. Even South Korea, who's handled this arguably very well, opportunities probably exist there for people that are willing to look. So I'd say the European markets are probably a no. Japan, probably a no for the time being. But as far as emerging markets go, it's worth exploring, and other developed nations may be worth exploring too. It just really does depend, I think, in looking at how this will impact different countries based on age breakdown, response time, etc.
Excellent. So we have another question. What parts of the economy do you think will be really hurting during the recession that may not be able to have such a recovery?
We already touched on a lot of them. Bars, restaurants, the tourism industry, hotels. Like, again, some will survive, some won't. Recovery will not be back to par for a very long time. So to recapture all-time highs is not likely in any near term. The energy industry too. I mean, if oil prices do not stabilize, we had an uptick yesterday in oil prices, but they're still well below profitable for a lot of oil companies. So energy is another area that I would say has a very difficult path to profitability.
So you're saying energy as a sector may not be a wise investment choice at this point? At
least not in the near term. There's a lot of uncertainty, a lot of debt issues. It's a very geopolitical, driven sector. So I'd say given the headwinds you already have, I don't think you're going to layer any more on top of your investments. So I'd say steer clear of that for at least time being if you can, at least for most investors. And financials too. I mean, financials are going to be in a unique situation where they're in a spot where they're trying to lend and help, and extend credit to people right now to weather this, but with no margin. So that's another issue for financials too. Is there's really not a lot of margin here for them.
That would be banks.
Yeah, banks, lenders, etc. So financials again, are there different companies that could benefit from this? Yes, but across the board, I think weakness in earnings will be around for years to come for financials. I don't see how they're going to turn this around and have growth in this environment. Right,
with the government giving essentially almost free loans, it would be hard for the banks to then compete with that.
Yeah, it's called net interest income is typically how they make money, and there's really no spread there at this point in time for financials. And then the other drivers of growth for them are also arguably stopping. Real estate markets will probably get from this too, and that's another area banks that make money, mortgages, etc. So I do think that's another area that will face long-term headwinds.
I understand. Well, that wraps up our seminar for today. For those of you who are watching, if you would like for Brandon to do a free analysis of your portfolio, you can send an email to me at debbie@burkefaulknerlaw.com. I can take out all of your information. So we just need your age and your, sort of couple of other unidentifying factors, and Brandon can analyze your portfolio to see if you're overweighted in certain sectors or if there's something that you should keep an eye on and that sort of thing. You don't have to provide your name or anything, and we can keep that completely undisclosed, so that you can have a second look at what you are doing in your portfolio today. So thank you, Brandon, for joining us today. We will be on next week with another Panic to Pandemic seminar. For now, please subscribe to our station if you haven't already. Take care, everybody. See you next week.
Thank you.